All right, so I got some interesting topics I wanted to go over from this past week. Also get into the market, what happened this past week as well. First things first, if you get value out of this video, please like and subscribe. I really appreciate that. So from Jim Bianco here, responding to the Atlanta Fed, on September 27th, the GDP Now model nowcast of real GDP growth in Q3 2024 is 3.1%. And he responds and says, highest of the quarter. So what does this lead me to believe? Well, this probably leads me to believe that it's not looking like we're going to get a recession, at least in the near future. Now, 6 months, a year, it's possible, but I mean, technically, a recession is at least 2 quarters of negative GDP growth, which means we would be at least 6 months away from that. And on top of that, it would take a little bit of time for the Fed and whatnot to be like, hey guys, we're in a recession. So we're looking at probably 9 to 12 months before we would be in a recession realistically. And it's unlikely you go from 3.1 to negative within a quarter or two. That would be, obviously it could easily happen, but it's pretty unlikely. So nobody knows for sure what's going to happen, but based on this data, it's looking like it's pretty unlikely we're going to get a recession, which is good news for stocks and whatnot. But the one problem that I think is still something that people have kind of forgotten about is we definitely could see a resurgence of inflation. So definitely want to keep an eye on that. But from the looks of things, we're not getting a recession. For all we know, it could be a year or two from now. That's certainly possible, but in the near future, it appears to be extremely unlikely, especially given we're going into we already are in a cutting cycle. So another thing to point out here is PCE came out on Friday, and it was actually the lowest since back in 2021, I believe. So that's another thing that also February of 2021. Which is slightly lower than the expectations. So that also points me to believe that, we're probably not going to get a recession. The one problem is inflation, but based on PCE, it's not looking like that's going to happen either. And I think there's conflicting things going on here, in that number one, the consumer's ability to spend money has definitely gone down a little bit over the last year or two. But on the flip side, we also have an easing cycle, which will mean more money flowing into the system. So I think the big question is which wins out there, and that's something that's going to be hard to predict. I still think near term bullish, medium to long term. I think we could definitely see some headwinds, but that's extremely hard to predict, right? It's extremely hard to predict. When it comes to Bitcoin had a very good week. It touched 65,000 US for the first time in a while. Almost 90,000 Canadian I think we hit around just over 89. And I think, I could easily be wrong on this, but I think this is the start of the real Bitcoin bull run, in that if you go back to 2020 post-halving, the big run-up was late 2020 and most of 2021. In fact, the all-time high was, I think it was November of 2021, maybe October, but October, November of 2021. So that's something that I think probably will repeat, in that when you look at the supply, well, this past week, ETFs bought far more Bitcoin than was produced. And I think that we're going to see more of that. And there's only so much of that can keep happening before the price starts to skyrocket. And I think that exchanges will continue to dry up, and the ETFs are going to continue to buy. And not only that, we are looking at banks are on the verge of being able to self-custody Bitcoin, which they can't do. Everyone's talking about, central banks, they're buying all this gold. And I don't think that banks will ever buy Bitcoin on the level they're buying gold. But if they buy it 10, 20%, which I think is realistic, then that's massive demand. That's massive demand. And we still have very little institutional adoption. We still are extremely early in the process here. So I wouldn't get I'm not personally discouraged at all over the lack of price movement over the last 4 or 5 months, because it's 4 or 5 months. This is Bitcoin we're talking about. If it went up 100% over the next 6 months, would it surprise anybody? Like, absolutely not. It would not surprise anyone if it went up 100% in the next, even 3 or 4 months, but for sure 6 months. So why are people all, paranoid and butthurt over this? To me, it doesn't really make sense. So that is that. As far as the markets go this week, everything was up. Not everything, but basically everything. The S&P was up, I think, about 0.5%. 0.44%. The NASDAQ was up more than that. I believe it was up just under 1%. The S&P did touch an all-time high Friday morning, and then it kind of trended a little bit down after the end of the day, but still up nicely on the week. The NASDAQ was up 0.82%. If we look at mid-caps here, I think mid-caps are up about the same as the S&P. Let's check that out. Actually, no, they were actually up about 0.2%. If we look at small caps, small caps were basically flat on the week, up ever so slightly. The Meg 7 were up, I think, about 1.5%, which, again, growth outperforming on the week, not necessarily that much of a surprise there. I still think, again, it's overvalued. Are people going to stop buying the Meg 7? No, because they make up a disproportionate amount of the SBY, the QQQs, VOO, even VTI, and some of those ones as well. So these, like the Meg 7, will lead the market. It's not going to track it perfectly, but it will lead the market. But you also have to keep in mind that it'll lead the market down as well. So if we see a 10% correction in the S&P, well, chances are it's going to be 15 or 20% for the Meg 7. So people think, I'm going to make all this money on the way up. But you also have to keep in mind that if it goes down, it's going to go down even more. So it's kind of, the Meg 7, honestly, it's kind of like a leveraged S&P or NASDAQ like fund or ETF, for lack of a better way of putting it. I don't own any of the Meg 7 stocks individually. However, I do have a decent percentage of my portfolio allocated to the NASDAQ and the S&P. I'll probably get those both up to about 10%, meaning any one of those given stocks will never be more than like 2 or 3%, which I think is pretty much exactly where you want it to be. And I think that owning the indexes is always a healthy way of going about it, even if you prefer stocks, which I do. My long-term plan is to have ETFs make up about 20-25% and individual stocks make up the rest. The main reason for that is I want to sell covered calls on those ETFs, and those kind of ones are the ones that have by far the most volume, and they're the easiest to trade. And over the long run, it's an easy way to simply outperform the market. I like stocks because I like doing the research. I like the challenge, and I think that I don't think that it's necessarily that hard to outperform the market. I think that the hardest part of investing is discipline. Like I haven't been in it for that long. I'm not an expert. I don't consider myself an expert. But the thing that I find the hardest is the discipline. Finding hard companies or finding good companies, I don't think it's that challenging. Definitely a little bit, but beating the market, I don't think it's that challenging, at least over the long run. The hard part is having the discipline. Having the discipline is the hard part. And that's something that I've learned, and you will continue to learn. I will continue to learn. So getting into the moves that I've made recently, I will continue to slowly, ever so slowly, sell off the corporate bond positions that I own, because those ones continue to go up, right? Those positions continue to go up, and I think as rates go down, that will continue to go up, and I will slowly sell that off over the next probably 6 months to a year, depending on how rates do. The new positions that I took recently, Domino's, that was one that I probably paid a little bit more than I should have. My average price is 436 roughly. That was a put that I sold. Again, almost every position that I take other than the Canadian stocks, because they don't have options unless they trade on the NYSE as well. Every position that I take is through selling puts. Basically, the thought behind that, I've explained it before, but I'll briefly get into it, is at least right now, right? But this works anytime. It doesn't matter how expensive the market is. But right now, the vast majority of companies are not undervalued. They may not be overvalued, but they're not undervalued. And the thought behind cash secured puts is you have cash, you sell a put, meaning let's say the stock is at $100, you think it's worth $90, you sell the put, you collect some cash, and if the stock doesn't go below 90, you keep the money, you're no worse off than when you started, and you can sell another one again. And you can just keep doing that until you get it for the price that you want. Now, people say, well, what's the catch? Because it seems like it's just a no-brainer. The catch is you sell the 90 put and it goes down to 80 or 85 or even 70 or 75, and you have to pay 90. That's the catch. But on the flip side, if it's a quality company, chances are it's going to come back. So that is the strategy there. Like I said, I bought Domino's. I probably won't buy any more of that because it's already about 4% of the portfolio roughly, which I don't really want it being over. I don't want it being any more than that. Louis Vuitton, I'm kind of kicking myself because it was down around like 133 this past week, and I was going to buy more. I think I put an order in for like 132.50 or something just below. And right after that, it shot up. I think it shot up to like the mid 140s. It is down a little bit after that. But Louis Vuitton is one I would like to get a little bit more of. It's about 3%, roughly 2.5%, 3% right now. The other one I took another position in this week was, there was one other one. I'm trying to remember it here. I am completely blanking on it, to be honest, because I can't see it right now. But that is basically what I did this past week. I am going to buy a little bit more T-bills because the yield is still like 4.5%, almost 5% still. That will come down, but I do want to have a little bit more dry powder if we get a significant correction in the market. That way I can take advantage of that, because my strategy for this has been all along for the last, whatever it's been, 7 or 8 months, is wait for that big market pullback and then pounce. And the way you do that is to have that cash ready to go and buy it when the time comes. But on the flip side, I'm also selling the puts, right? I'm selling the puts on the companies that I like. In fact, right now I have probably almost 200 puts outstanding, right? So if any of these companies get down to those strike prices, I will own them. And that is the strategy. And this is the strategy because this is a buy and hold. This is something that I want to simply do for 20, 30, 40 years. And given that, I don't care about buying right now. If the company becomes a good price, you buy. If it doesn't, you don't. I have puts out on Nvidia right now, Microsoft, a lot of these companies that I like, they're just way too expensive. And if they never get to a fair price, by all means, they never get to a fair price. That means that I just sit back and collect cash selling those puts. So I think that is the no-brainer strategy right now, is to be patient. That doesn't mean that there isn't some value out there, because there certainly is, but it's to be patient because eventually we will be in a clear buyer's market, and that's when I think the time is to pounce. So anyway, that is my thoughts from this past week in the markets. Like I said from the start there, if you liked the video, please like, subscribe, comment, all that good stuff, and stay tuned for more.